Bismillahirrahmanirrahim. So, in the previous class, we were discussing about mutual funds types. As you can say, open-end funds types, and we discussed about money market mutual funds. The second type of mutual fund, it is equity funds. You know about equity, one is debt and one is equity. Equity, the word equity, it is used for shares. Hold primarily stocks. They are investing their money in shares, in stocks. It is further divided into capital appreciation funds and total return funds. Capital appreciation funds, these are basically those mutual funds whose aim is the capital appreciation. Basically, they are investing in those funds in which the chance of capital gain or capital appreciation, it is high. Suppose today we purchased a share for $10 and we are expecting that its price will go to $12 or $13 after 1 month or after 2 months. So we are investing in that, and after that, if the price goes up, what will we do? We will sell those and we will generate capital gain. The second type of this equity fund, it is total return funds. Seek a combination of current income and capital appreciation. These are those funds which are looking for both the capital appreciation and current income. Capital appreciation we discussed, if the prices goes up, so we call it capital appreciation. And current income means they are looking for the dividends also. Means they are looking for those funds in which there is chance of dividend as well as there is chance of capital appreciation. Then there is a third type of mutual funds, equity funds, world equity funds, invest primarily in stock of foreign companies. These are those mutual funds which are investing their money only in foreign companies' stock. They are not investing money in local companies' stock. They are investing in foreign companies' stocks. Then the third type of mutual funds, we discussed money market mutual funds, and the second one is equity funds. There is a third type that is called bond funds, hold bonds. These are those mutual funds, these are those open-end investment companies which are only investing in bonds. They are not investing in stocks. In these, then there are again, it is further divided into two. One is taxable bond fund and one is tax exempt bond funds. There are some bonds which are taxable, on which you will pay taxes to the government, but there are some bonds, bonds issued by government, we call it T-bonds. Treasury bonds. One is treasury bill, T-bills we shortly call it. One is treasury bond, long-term bonds issued by the government. Some bonds are tax exempt, so they are mostly investing in those tax exempt bonds. Then there is a fourth type of mutual fund that is called international funds. Mutual funds that concentrate primarily on international stocks as well as on international bonds. Mostly these are those mutual funds that are investing in international bonds and stocks. So international funds, mutual funds that concentrate primarily on international stocks. Bonds are also coming in this. Then there is the fifth type of mutual funds, that is called global funds. Mutual funds that keep a minimum of 25% of their assets in US securities. If a mutual fund is investing their 25% shares, 25% money in US securities, so we call it global funds. Don't mix these two. We call it global because of this 25% investment in US securities only. 25, it will be a global fund if 25% money is invested in US securities. Keep this thing in mind, that if 25% money is invested in US securities, then it will be global fund. It will not be international then. Single country funds, so that is another type of mutual fund. Investment companies, primarily closed-end funds, concentrating on securities of a single country. These are those funds which are investing their money in a single country, means those funds which are those investment companies which are focusing on investment in a single country. Suppose there is a mutual fund and that mutual fund is just investing money in Indian Stock Exchange, not in others. Or there is an investment company that is investing their money in Pakistan Stock Exchange, or they are investing money in London stock market. So it will be called single country funds. Then there is another one, the last one, that is called hedge funds. Hedge funds are unregulated companies. No rules and regulation for these investment companies that seek to exploit various market opportunities. They are looking for different market opportunities and thereby earn larger returns than are ordinarily available. Means they are looking for different opportunities in the market. So because of this different opportunities, the return of this hedge fund is also high. For example, they may use leverage, that is the amount of debt used to finance a firm's asset. They are using what? Leverage. They are taking loans. A firm with significantly more debt than equity is considered to be highly leveraged. So it will be what? It will be highly leveraged funds, and keep in mind the risk will also be high. Are derivative securities. Are they are investing in derivative market, options, futures, forwards, swaps. So they are looking for that. In these options, futures, forwards and swaps, the profit margin is also high. Or they may invest in illiquid assets, or they are investing their money in illiquid assets. Illiquid assets means land, building, and furniture, these types of assets, which will take too much time when you are in need of money. When you will convert it to cash, it will take too much time. Land, if you got a land and you want to sell it, so it will take too much time. But if you have a stock and you want to convert it to cash, it will not take that much time. They require a substantial initial investment from the investors and may have restrictions on how quickly investors can withdraw their funds. If you people remind, I told you about one point that mutual funds or in open-end funds, if this is fund and this is public, so when they are issuing shares to the public, and anytime public can return these shares to the company. But in these hedge funds, there are restrictions on the conversion of the shares back to cash. Suppose company issue shares. Now there is a person by the name of Ahmed, and Ahmed want to convert his shares. Ahmed purchased the shares, paying $100 to the company. Now after 1 month, he wants to convert his shares back to cash. So what will he do? He will return the share and he will get money back. But in hedge fund, there is restriction on the conversion of shares back to cash. Means there will be a time limit. Before that time limit, you can't convert these shares back to cash. So see here, what is he saying? They require a substantial initial investment. Basically, if you are investing in land, building, furniture, and these types of assets, then you need a huge additional investment, initial investment. For investors, and may have restrictions on how quickly investors can withdraw their funds. And on withdrawing their funds, there are restrictions. Just like I told you, you can't give it back to company. If you want to give it back to company, there will be a time limit. Before that time limit, you can't convert your shares back. This is a feature of open-end fund, that anytime you can buy shares from company, anytime you can sell it back to company. But in hedge funds, there is a time limit. Before that time limit, you can't convert your shares back to the cash. So now I'm coming back and I am just reviewing this chapter. In this chapter, we discussed about indirect investment, we discussed about direct investments, then we discussed about investment companies, that what is investment company. Then after that, we discussed about investment company types, we discussed about unit investment trust. Then we discussed about exchange traded funds. Then after that, we discussed about closed-end investment companies. After that, we discussed about open-end investment companies. Then we discussed that which types of mutual funds are there in the market, that is types of open-end funds. We discussed that the first type of mutual fund, it is money market funds. These are those mutual funds which are investing their shares only in money market, that is T-bills and commercial papers. Then we discussed about 3 types of equity funds. Capital appreciation funds, they are focusing on the capital appreciation, means they are investing in those money market funds in which there is chance of capital gain. The second is total return fund, that is they are focusing on the current income as well as on capital appreciation. Then we discussed about world equity fund, those money market funds which are investing primarily in stock of foreign companies. Basically, those here it is written that it is stock, but it is basically short-term money market securities. World equity funds, so money market funds are coming in this, that is T-bills and commercial papers in international markets. Then we discussed about bond funds, that is hold only, they are investing in bonds. Then these bonds, we discussed that there are two types of these bonds. One is taxable bond funds and one is tax exempt bond funds. Then after that we discussed about international funds. They are investing only in international stocks, shares of international companies. Then after that we discussed about global funds, that is mutual funds that keep a minimum of 25% of their assets in US securities. There is a difference between these two. If a company is investing, if a mutual fund is investing their money in international markets, that is they are investing money in purchasing bonds and shares in India, in China, in London stock market, in US stock market, etc. In global funds, at least they will invest 25% of their assets in US securities. Means the minimum 25% investment, it is must in US securities. Then your fund will be called global funds. So this is the difference between these two. One is international funds and one is global funds. In global funds, minimum 25% investment, it is must in US securities. But in international funds, this 25% investment, it is not must. Then there is another type of mutual fund, that is single country fund, that is the fund that is investing their assets in one country's stocks and bonds. That is, they are not investing their money in other countries, just one country, single country funds. Then the last type of this mutual fund, it is hedge funds. Basically, this is a type of mutual fund that is investing their money in risky investments, simply. They are investing in options, futures, forwards, swaps, and they are investing their money in in illiquid assets. That is, liquid means you can easily convert it to cash. Illiquid means the conversion of which will take too much time. The conversion of those assets to cash will take too much time. So we call it illiquid assets. So they are investing in illiquid assets. But keep in mind one thing. They're looking for each and every opportunity of generating profit. So for this purpose, they are taking a risk. And when they are taking a risk, the chance of profit, it is high, but the chance of loss, it is also high. And also they are investing in illiquid assets. And see, derivative securities, they may invest in illiquid assets. But if you will invest in illiquid assets and derivative securities for taking high risk, they require a substantial initial investment. You need a huge initial investment from investors and may have restriction on how quickly investors can withdraw the cash. But keep in mind one thing, that okay, in open-end fund, anytime you can buy shares, you can return these shares to the company and get your money back. But in this hedge funds, there are restrictions on the withdrawal of cash. Means if you want to return the shares to the company and you want to get your cash back, so you can't do this thing. There will be a time limit that okay, before 1 year you can't withdraw your cash. So see, I'm telling you that there is a time limit. Suppose I give you an example that there will be 1 year time. So they are fixing the time, 1 year, 6 months, that before 6 months or before 1 year or before 2 years you can't convert your shares back to cash. Means the company will not take your shares back from you till this time. This is the end of chapter. Inshallah, in the next class, then we will discuss about the fourth chapter, and inshallah we will start it. Okay, assalamu alaikum.